Hello and welcome to Bondcast, a podcast series where we discuss our views on the latest themes and events shaping rates markets. I'm Imogen Bachra, UK rate strategist, and I'm joined today by our global market specialists, Jan Nevruzi and Giles Gale. Okay, lots to talk about this week because we have, a quiet week, I suppose, really this week, but a very busy week next week. I actually can't remember the last time that we had the Fed, the Bank of England and the ECB all in 1 week. Although I'm sure someone's going to tell me now it probably happens every December, but there we go. So let's get cracking. Let's start with the US and the Fed, Jan. What are you expecting from next week's meeting?
So from the Fed, we're really looking for two things: the quarterly projections and the press conference following the announcement. The 50 basis point hike has been very well communicated, and we don't think the Fed will diverge from that path. That's been priced in, and that's very, very likely what we will get. On the quarterly projection side, we're mostly concerned with the so-called dot plot, the Fed members' projections for where they see interest rates going over the next few years. And last time around, the peak was at 4.6%. We think this time it gets bumped to 4.875%, so another 25 basis point increase. It's really hard to imagine a scenario where they go really much past than that. We did envision if CPI comes much stronger than we expect, maybe another 25. But since it's the median that the market cares about, seeing that go well past 5.125 is very hard to imagine. Market's right at 5%, so in between those two, and it would be hardly a shock to get in either direction. If anything, 4.875 could be a slightly of a shock. But even using the word shock is not really appropriate in this case. And finally, we'll also be looking at the divergence of the projections, the dispersion. Last time around, it was 100 basis points from the lowest to the highest forecast. This time, it could even widen to, say, 150 basis points, 175, as the opinions within the Fed have been, both vocally and we're sure kind of internally diverging in some people are more worried about financial risks, others are more worried about resurgence of inflation after it comes down for a little bit. So that's one of the signals that we want to take into consideration, engaging whether investors should fight the Fed this time, I guess. And finally, Powell's press conference. Our view is that post the Brookings Institute, which saw last week, there was a Brookings Institute appearance by Powell, and he wasn't necessarily dovish, but he wasn't kind of hawkish in the other direction as well. And markets took that in a stride and ended up buying bonds across the curve, and that was a pretty big rally. And post CPI, financial conditions have loosened significantly, and I don't think he will want to quite allow that to happen going to next year as well. Our view is that he will push back a little bit against that and kind of not allow a lot of this tightening to be unwound quite yet, because the inflation is still fairly high, and they acknowledge there's a lot more work to be done. And it just has been one positive signal that we received from last month on inflation.
Yeah, let's talk about inflation then, because it's not just the Fed next week. We obviously also get the inflation data. How much is that going to matter and feed into the Fed's decision next week? And what are you thinking about that print?
I think it matters. We've revised our forecast actually slightly lower than like our estimate a couple of weeks ago. Now we see the core number coming at 0.4, headline a 0.25, so like rounded to 0.2. The headline part is because energy prices have kept falling in the U.S., mainly from you can gauge by gasoline prices, and so they've been in a continuous decline. And on the core side, we expect a little bit more of a drop in used car prices, which we use alternative measures to gauge, and those have been signaling a fairly sharp month-to-month drops. So last month we had I believe it was like 2.4% drop in used car price in October. We're looking for another 1.4% drop there. So those should act kind of like pull down on the core a little bit more again. On the other hand, you still have somewhat stickier components like shelter adding the upside pressure, even though they've moderated compared to a couple of months ago. And we think the peak in those that have come in, they take longer periods of time to entirely normalizing. Their profile is not super sharp on the way down, as well as other transportation services such as airfares and car insurance and smaller components, but tend to be a little bit more volatile. So swings in either direction could, a basis point here, basis point there. Before you know it, you got 5 points in the monthly read.
So let's see. Okay, so how does that leave your rates views then, I guess, for the next couple of weeks and heading into 2023 as well?
And year ahead, our outlook has been for lower rates into next year and actually steeper curves as well. But rates have now rallied well past our year-end target, and we do think it's been a little bit too much at this point. So tactically, and going to the Federal Reserve and into next year, the Fed meeting and into next year, we are actually short the kind of like longer end, so 10s and 30s. That's because we think it overshot a little too much on anticipation that the Fed is entirely pulled back, and markets are really exposed to a hawkish pushback from the Fed and generally an upside beat in inflation, because the front end is pretty much going to remain pinned where it is. It's unlikely to see it kind of drifting much lower. While the long end, so any selling really, or like more news related to tighter financial conditions could come through longer end and kind of like lift the curve up and lead to higher yields in long end. So in the near term, we are a little bit bearish, longer dated yields, but into next year, we think the trend of kind of like lower yields and steeper curves is going to continue.
Okay, that makes sense. Right, over to Europe then, because it's the central bank meeting there as well. I guess quite an important one for Europe, because it feels like we should get a little bit more detail on QT. Obviously, the ECB is slightly behind where the Bank of England and the Fed have got to on kind of unwinding their QE purchases. But not to steal your thunder, Giles, tell me, what are we expecting from the ECB next week?
I think we're really looking for three things. The first, of course, is what they deliver on rates, where rightly, I think there's a pretty strong consensus that 50 basis points is what will be delivered. The risks are clearly on the upside. Perhaps there's some kind of deal to be cut around things like the timing and nature of quantitative tightening. Maybe they just want to have the confidence that they will enter next year with rates at a level where they're going to be sort of random walk 25 basis points from there on. But 50 basis points seems like the right decision. 20% probability of 75. Also, I can't particularly argue with that. The next thing is that the projections will extend to 2025, so there'll be quite a bit of focus, I imagine, on where they project inflation at that point, the end of their projection horizon. I guess your base case is that with basically 3 years, they should be expecting to return inflation to 2%, but they may signal that there's a risk that they will see inflation a little bit higher. So I think, again, we shouldn't be too surprised to see a projection that's slightly on the high side of 2%. And finally, of course, quantitative tightening. So what are the principles around that?
What are the principles then that you're expecting them to announce on the QT front?
Well, okay, so I don't think that we're expecting anything too detailed. I think that the main elements are, we're expecting, of course, partial reinvestment. We're not expecting them to be talking about bond sales. They may make that explicit. I think that there will be a restatement, we've heard it before, but there'll be a restatement that rates are and will continue to be the main policy tool. And so there's this idea that quantitative tightening needs to be something which just happens in the background and continues even if the rate cycle actually, for whatever reason, needs to turn. So I think that there will be language around that. There will be some discussion of potentially, I suppose, which programs are affected in the APP. I assume all of them, and I assume that there'll be flexibility around that. So that will be something they'll want to mention. I think that, like their reinvestment program, which of course is smoothed over the year, so they don't just automatically reinvest the amount which it redeems in any given month. I think that they will make clear that that will be the broad manner that they will continue to approach managing the balance sheet. So it'll be smoothed. It won't be it won't be lumpy and driven by the redemption profile. And finally, I think that there's a question of some kind of precondition around volatility. So I don't think that they want people to be expecting them to be forging ahead with quantitative tightening regardless of market conditions.
How does that fit with market expectations, do you think, of what the market's looking for from QT?
So what I didn't say is that I think that the way that this pans out is we get 50 basis points this month, or this week, then what am I talking about, next week, and then 25 basis points in February, and then they make the announcement about QT to start in April. They make that announcement in March, and whilst I think that that is probably where the consensus is, whenever we hear different, it's always, why don't they start earlier? So I think that there is some expectation that actually we may be surprised this next week by an announcement that actually it's got to start sooner. So it needs to start in January. Definitely don't think that's likely, but that is something that we.
Okay, just to round off the ECB discussion then, kind of a bit away from next week's meeting, on Friday, we will get the number for how much TLTRO has been voluntarily repaid in December. Obviously, some listeners, or probably everyone, will be listening to this after we've had that number. So I'm not asking you to kind of bet your house on what that number is going to be, but how important is that really going to be, do you think? And I guess particularly when we're thinking about the kind of collateral scarcity theme at the front end in Europe.
Okay, I'm going to answer that in just a second, but I've just remembered something else I wanted to say about the QT and
okay.
Because I think it's an important point. I don't think that the ECB wants there to be an announcement effect when it comes to quantitative tightening, and that's very different to the way that they approached quantitative easing. So that's why I think you get principles and then you get an announcement further down the line when all they're doing is basically fulfilling what we all expected. Okay, so on TLTRO repayment, okay, well, listeners, go and check your Bloomberg screens. I'm calling for 600 billion repayment. So taken together with the 300 that we've already had, that would be 900 repaid before the end of the year. We got to that number by taking a look pretty carefully where the liquidity drains and trying to think about the incentives that individual banks and institutions face. How confident am I? Not very. but we will see. I think that one thing that I would say about that, though, is that it seems possible, maybe likely, that the best quality collateral has already been released, because in that first round of 300 billion repayments, because if you're recalling collateral, what do you, as a bank, what are you going to recall? Well, clearly the liquid, valuable stuff before recalling your illiquid loans and all that kind of thing. So there may not be a commensurate improvement in sort of this collateral scarcity, which we have seen, and it's already been actually reasonably impressive what we've had so far. So I'll just caution there. But we are in the process. Those of you who actually read our research, we're in the process of preparing a preview of all of this, and we will also be discussing things like the possible impact on benchmark, Esther, Euribor, and so on, looking a little bit further ahead.
Nice teaser, I love it. Okay, shall we talk about the Bank of England then, given that that's also coming up next week?
Yes, I think we probably should. but perhaps you'd just like to give us a little bit of a recap on the focus for this week. Because we've had a lot of supply between the DMO's efforts and the Bank of England's auctions, which have been every day, I believe.
Yeah.
How has all been going?
Yeah, it really felt like this week, I guess, was a bit of a preview for how it could feel pretty consistently next year, I think, with the Bank of England obviously having a lot of auctions. Like you say, we've had the Bank of England coming to the market every day this week, and then 3 auctions from the DMO as well. So a fairly heavy and constant supply schedule, but actually the market has pretty much taken it in its stride, and for all of our concerns around, the Bank of England seemingly in quite a hurry to get these kind of financial stability long end purchases out the door, and actually concerns around the fact that, perhaps they were selling bonds into a still illiquid market that hadn't maybe been fixed as much as they might like to think since the September and October volatility. Actually, yeah, like I say, the market's really taken it in its stride. The supply from both the Bank of England and the DMO this week has been really well digested. We've seen big numbers on the QT front from the kind of reverse inquiry, that demand-led QT, but also the linker auction yesterday, for example, was very well bid as well. So I think there's 2 takeaways really for markets here. The first is that they're pretty far through their kind of financial stability QT. We still have another week of that. So although active sales, regular QT stops, there's still another week of financial stability QT. They've already done about 6 billion and they've only got about 19 billion to go. So I'm not suggesting that they can get through all of that this side of Christmas, but they've made a good dent in it. And particularly on the linker side, they've sold more linkers, about nearly 3 billion today as of recording. They'll have done a bit more probably by the time we listen to this. But they only bought about 7 billion linkers. So they're pretty much halfway through their linker supply back to the market, and a bit less far through the nominals. My takeaway is that it probably means that they do add long end conventional gilts to their kind of regular QT auctions come Q1. I think that was always their intention anyway, and that was what they would have wanted to do. But I just think strong demand now probably gives them a bit more comfort that it's a market that they can also add, additional longs to. So that's kind of why I said it feels like this week could be a bit of a precursor for how most weeks are going to feel next year. Because if they're doing shorts and mediums QT, every other week, and long QT every other week, and then 3 financial stability QT auctions on the other days, it's going to be pretty constant from the Bank of England. But my concern is just, listeners will know that I'm bearish, so perhaps I'm thinking about this with a bit of a bearish tilt. But my concern is that, there's a lot of the bonds are being taken down now by LDI and other kind of market players, and that will mean that they won't have much demand heading into 2023 because they're almost kind of filling their boots now with these bonds. And actually, it's 2023 and beyond that we see the big issuance increase, and I worry that means that we're actually going to see a step down in demand next year, but let's see.
Okay, and just building up, first of all, thinking about next week, there's also an awful lot of data. Do you just have a couple of words about what you're looking for there?
Yeah, you are correct. It's not all about the US next week. The UK will get still a little bit of limelight. It's the major data week, so we get everything from inflation, growth, labour market data, retail sales, etc. Obviously, the main focus for us, partly because I think it's the main focus for the Bank of England, will be on inflation and on wages. So when it comes to wages, we see another increase in the total pay measure. That we think month on month that rises by 6.3%. That's probably close to the peak, but I guess importantly for our inflation profile, and when we're thinking about this for the Bank of England, we don't have that coming down particularly quickly next year, despite our kind of weak growth profile. On the inflation front, we think that we're kind of close to, if not at the peak on CPI inflation. So we actually have it remaining steady at 11.1% this month. That's actually slightly higher than the market. The market's, I think, about 10, or consensus is 10.9. So slightly higher. But I guess the point here really is whether we peak this month or next month, or we have just peaked, that we think inflation is going to remain pretty sticky, or headline inflation will remain sticky for the next couple of months and start to come down quicker beyond Q1. But core CPI is going to remain remain sticky, we think, into 2023. And we don't have, I think we've probably said it on the pod before, but we don't have inflation coming back down to the bank's target of 2% until 2025. So although the peak may well be in, we're not talking about a kind of rapid decline in inflationary pressures, we don't think.
Okay, and for the main business next week, a word on your base case for the Bank of England?
Yeah, so I think the Bank of England in some ways is probably going to be a little bit less interesting than the Fed and the ECB, partly because, for all you were saying, Giles, about the ECB wanting to set QT just running in the background, that's exactly the bank's strategy as well. So I don't think we're going to get any updated information on QT at all. That's, they've kind of disentangled QT decisions from their MPC meetings, and they come separately. It's not one of the quarterly forecast meetings, so we don't get any updated projections, and we don't get a press conference. It will just be the minutes. So this meeting for us is really just going to be about the rate hike and the vote that sits behind that to try and kind of determine, I guess, how much further there might be to go in rates. I say it's not going to be super exciting on the surface because I think we have enough consensus call for what we think that they're going to do. Our base case is still that they do 75 basis points rather than 50 basis points, which I think is probably where there's quite strong market consensus. I think I went probably into a bit too much detail last week about why we think 75 and not 50. So I won't repeat all of those, and I'll just point listeners to the direction of that pod if they're interested for last week. But I guess suffice to say that we think it's a pretty close call between 75 and 50, but at the moment think the kind of the fact that inflation's still overshooting, that we still see kind of strong labour market data next week, that should be sufficient to tip the balance. But it is a close call, when we're thinking about this from a vote perspective of where will the votes for 75 come from. I think you can probably quite obviously put Mann in the 75 camp. We're also assuming that Haskell and Ramsden vote for 75. And then in our kind of possible, maybe probable 75 basis point camp, we have Pill and Bailey. So that's 5 for 75. But then you might well get this long tail of voters that think 50 or even 25, or perhaps even no change, at the very dovish end of expectations. It could be Temrero and or Dingra that think that, rates might have got as high as they need to, or, just looking for one kind of 25 basis point hike. But probably, I guess, the important message here and certainly when we compare this to market expectations, is not really about whether they do 75 or 50 next week. I think it's more just about, where we see peak rates and when we see that peak arising. We still think that they only get to 4.25, so we have 75 next week and then 50 in February, and that takes us to 4.25 as our kind of peak rate, and then we think they're done for the rest of the year. So probably our biggest pushback against market pricing would be how much of a higher and later peak the market sees. The market's still thinking that the bank is hiking well into the summer, which given our kind of inflation profile and growth backdrop, we think that pricing is probably a bit too high and late, I would say. Okay, let's stop there. So, okay, we'll catch up next week after all these central banks, and then next week will be our last Bondcast of the year. So I'm sure we'll make it very festive and fun after all the stress of the central bank that week. Thank you all for joining me, and thank you to our listeners. Just a reminder that if you liked today's episode, don't forget to hit the like button and click subscribe so you can get the latest episodes as soon as they're available. Thanks, bye.